Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, Phil Tarrant. How you going? Smart Property Investment. Welcome to 2022. Hope you're well. Hope you're enjoying the break, recharging, resetting, recalibrating, whatever word you can think of as we get set for the big year that is 2022 in property. Who knows what's going to happen with this COVID-19 pandemic. One bit of information I have for you, get used to it. It's not going away any point soon. It will just become, in time, I believe, based on what I'm reading from different people, normalised. However, that does not stop the impact and implication it continues to show. It's going to be a busy year as we go into budget, which I understand is in May, federal election on the way through. Who knows if there'll be a change in government, what that means for Australian property investors, all this sort of stuff. What I do know is that you can control what you can control. Don't get too concerned about the stuff you can't control. And it's exactly how I approach investing in property, particularly in the Smart Property Investment Show. So as we sort of come into 2022, as we kick off the year, I just wanted to really do a bit of a portfolio update, give you a sense for where the Smart Property Investment portfolio is right now and what our plans are for the coming year. If you haven't listened to this beforehand, you can go back and listen to a whole bunch of portfolio updates. One of the reasons why we created Smart Property Investment many, many years ago, back when it was actually a print magazine, was to dispel a lot of the rumours, innuendo, the lies, the skullduggery, the lack of information, the lack of truth that we saw in property investment, where the only stories you ever saw from property investors were the glowing ones, which made it look so easy to invest in property. They were always the how I got rich overnight type stuff, how I become a property millionaire in only a handful of properties, all this sort of stuff. We went, I don't know. It's not really the way it works. So let's do it ourselves. Let's build a portfolio inside of Smart Property Investment. And that's what we've done, the Smart Property Investment portfolio. Go to the website, smartpropertyinvestment.com.au. You can go and check it out. What we've been doing over many years, which includes buying and renovating and all the trials and tribulations of being a property investor, often about how inadequate I personally am as a property investor and how I've been able to sort of dodge a lot of bullets because I've been able to surround myself with people who know what they are doing. So as we come into 2022, we have a very mature portfolio now. We've been investing for a decade. Last count, if you want to look at the numbers, and it's been a good year over 2021, property across Australia hiked by about 20 to 24%, depending on what numbers you choose to listen to. So our portfolio rounded out the year sort of, probably between $8.5 and $9 million. The numbers keep going up. I sort of go put a big question mark around it and say, really, what's the thing worth? But we're operating at about a sort of 50, 55% LVR position. So heaps of equity in the portfolio. It's performed well. I've spoken a lot about it in the past. Go and tune into it. It's outside of the scope of today. But what I really wanted to look at is how we can capitalize on 2022 and how we can best be framing this portfolio to capitalize on property moving forward and what that might look like. I've called in the studio the man that's helped us build this original portfolio, Steve Waters. He's director at Right Property Group. He was the buyer's agent who secured the properties inside of this portfolio. I did all the hard work. He didn't do much at all. So I'm going to claim all the benefits from it. I'm just going to say I was smart enough about bringing this bloke in at the right point in time. Steve, how you going?
Yeah, I'm not sure how to
That's
what to make of that introduction, but
that's a compliment.
Yeah, you're right. Good to be back, mate. The hostess with the mostest.
Yeah, well, yeah. I much prefer doing this, by the way, Steve, as a podcast rather than written journalism. It's a lot easier to, number one, it's more efficient. And number two, I think you put a lot more personality in a podcast. So that was probably about 2,000 words there I would have had to write back in the day. But now I can just sort of riff on the Smart Property Investment Show chatting about this. But, I really enjoy talking about the portfolio on on a Smart Property Investment podcast, the Smart Property Investment Show, because it's hugely popular. People like it. People want to know what's going on.
They do.
We haven't bought anything for a long time, but it's still as relevant as what it is before.
I recently saw a photo of you and I don't know where we were, but we're out somewhere, and we were someone's taken a photo of us you and I doing a portfolio review with like pen and paper.
Okay.
Which I thought, now that's going back some years.
That's in the coffee shop behind us here, I think.
Oh, is it?
Yeah.
I had a feeling it might have been an expo somewhere.
Maybe. I think by memory, we were planning the 3-day renovation of that property that we had we still have in Mount Druitt there near Westfields. Yeah, where we renovated it in 3 days. So new kitchen, new bathroom, new flooring.
Everything was new, down to the light switches, down to the paint, the fixtures and fittings. Like,
did we do new floors? We did new floors.
Yeah, everything. Like, look, there was nothing left that was other than the brickwork in that unit that was left original. Yeah,
there we go. So the journey that has been a Smart Property Investment portfolio, 17 properties, 18 doors, because one of them's a duplex. As I said, the valuation of now, who knows? Every day you look at it, goes up by about 10 grand. If that's the way you want to sort of price your portfolio, better than being a podcaster, I'm telling you, than be a property investor. But yeah, that's done well. It's performed well. If you think about it, if you got 20% growth on a $8 million portfolio, what's it grown in the course of a year? It's a big chunk of change.
It has, but there was also years in the beginning where it grew in line with what we expected it to do, and then it went sideways, as basically all asset classes did around property anyways, for various reasons. It's had its trials and tribulations around repairs and maintenances and financing challenges, and as the cycle evolves, as it does all the time, you will eventually get the benefits of compound growth if you hold it long enough, and that's what you've just experienced.
Yeah, if you hold it long enough. And I've shared on this podcast some of the parts of portfolio which I'm not that happy with, and that is cash position. It costs us a bit to hold the portfolio. The last couple of years, I went through that process, and we spoke about it on a Smart Property Investment Show, Steve, of repricing a lot of the interest rates, putting that time, energy, and effort into speaking to banks to get sharper rates. That's been done. A lot of stuff come off fixed rates. That was good. And the mortgage rates, by and large, are okay at the moment without having to refinance. So that's reset the holding cost of this portfolio. However, in the interim of that, a lot of the mortgages have come off interest only in our P&I. So all those savings that I had made by shaving some points off the interest rates have been absolutely compensated by the increase in the repayments, because I'm now paying principal probably on about 5 to 6, maybe 7 more of the properties. So, which I'm sort of okay with.
Yeah, if you're going to do it, now would be the time to do it because of the stage of maturity that it's at, and because P&I rates are quite attractive, as opposed to being P&I at 5%, looking back at it historically. But it's also to some degree a time versus choice scenario as well, meaning that, do you have the time to put in the copious amounts of paperwork to rejig it back to interest only, firstly, and secondly, do you want to?
Yeah, and I don't have the spreadsheet in front of me. I haven't looked at it for about a week or so. But by memory, about half of the negative in this portfolio now is principal repayments on the loans. So when I sort of take that away, and then I take away some of the other bits and bobs, look, it's a good portfolio, and I'm okay. We can carry the negative in it, and by and large, as the portfolio matures and continues to mature, and the income it generates through increasing rents equalise, it's always going to be negative. But I reckon it's not far away to the point where the negativity in this portfolio, Steve, will be the principal interest components.
Yeah, I think that's a very good point, because the portfolio's position also has a heightened degree of complexity and sophistication around it, just from a financing point of view. There's a lot of added costs in there which a lot of people wouldn't have because of entity structure and the like, which was a necessity, but you're reporting on it as well, which is good, so that the reader, the listener, can see everything. But a lot of people don't have that cost structure as you do. And then, of course, once again, the choice around, with that structure that you have, also comes a small adjustment in pricing in terms of interest rates as well.
Yeah.
And then the time needed to jig it, even just slightly takes a lot of time. But coming back, sort of swing around to your point, that there's every possibility that the cash flow scenario will be the principal component should you want to put the time and effort into doing it. And then we haven't even talked about the rental increases as well, which, there are some there that are behind the eight ball as well.
Yeah.
But it's just this time of year, you'd be a pretty game person.
Trying up rates.
Yeah.
Well, there's a lot of competition for rents, and you're already seeing now a lot of the narrative coming out of sort of forecasts around this saying is that rents will rise, depending where you are at different sort of levels. But as we start to accept a lot more people back into Australia, whether they're sort of students or, migrants, it's going to put a lot of upward pressure on rents, which should definitely help the cash position. But, you've got to understand your own portfolio and where your comfort level is. Now, I'm not hemorrhaging money. I don't need to sell anything in this portfolio in order to keep my head above water. So, that's a good place to be. That's how you make a few bucks in properties, hold it over the course of time. We're pretty heavy, Steve, as you know, because you helped build the portfolio in Brizzy. We've held a lot of assets up there for probably 5 years without much going on. We're now starting to reap the benefits of time now of that in our portfolio. There's an argument to say, well, we probably could have bought a lot of this stuff 2 or 3 years later, and now we're getting that upside growth in it. But Brizzy's firing. That'll be a good performer moving forward. But the big thing for us as we sort of come into and moving through 2022 is, number one, how do we balance out the cash situation? And I think commercial property will help with us. We're also thinking about doing some more sophisticated stuff. Let's get into that. I want to have a chat about it, but we'll go to Brett beforehand. Stay with us. Back in a moment.
Looking for a blue chip Gold Coast investment property, or trying to relocate to the beautiful sunny Gold Coast but keep missing out on the right properties? Maybe you need an expert on the ground to source the right property for you. The Srama Group are the leading recommended buyers agency specific to the Gold Coast, providing their clients with exclusive off-market property opportunities, specific insights into market, combined with a large network of dedicated professionals to ensure you make the right decision without the hassle. Get in touch with us at thesramagroup.com.au and secure your financial freedom today.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Steve Waters from the Right Property Group, chatting through the Smart Property Investment portfolio with our portfolio property update podcast, where we're going, how we're seeing 2022. Now, Steve, we've spoken about this at length for many years. Property's a game of finance. You need your finance sorted out. We're now, and this needs to be the first thing that we do inside of the Smart Property Investment portfolio, is that to start thinking about how we can extract some equity from it in order to look for opportunities. No use even worrying about thinking about opportunities until we've actually got the equity extracted. And that might sound like a pretty clinical term, extracting equity. Pretty much what we're doing is refinancing it. So we need to do that first. It's quite a sequential type of strategic body work that needs to happen through that. And when we come on next time, we'll sort of go into more details. Is really understanding what properties are worth refinancing and why. And that's pretty much where you need to start at, probably that property level. And by that, the whole portfolio is due a good refinance. Some of that refinancing might not be topping up these loans. It might just be getting a sharper rate and even fixing some of this stuff moving forward. So we need to go at a property by property level. Once you fix a mortgage, it's very hard to break that mortgage without sort of copping heaps of fees. So you need to make sure the stuff you're fixing is probably on the properties that you're not going to do anything with. So we need to get that done. But then also looking where we can extract some equity and then what we're going to do with that equity. So I want to chat about those two things in isolation, but they're sort of one and the same. You would have heard a couple of weeks ago, I spoke at length on a podcast about some interesting news here at Smart Property Investment, how we've taken investment inside of a mortgage broking company called Finny Mortgages. Steve, I don't know if you listened to that particular podcast, mate. No doubt you do. You can't wait to listen to the Smart Property Investment Show every single week. But
every night before I go to bed, Phil.
Every night to send you asleep. And one of the reasons why we did that was, number one, to help property investors with property finance. But number two, I wanted to use this facility, this engine myself, to get our portfolio refinanced. And we're going through that process now. I'm working with the team over at Finny Mortgages to do that. And we're doing exactly what we're talking about here, Steve, isn't it? It's about going, okay, should we refinance the whole portfolio, 17 properties? And I think there's probably about 20 loans on that. So by that, some of these properties have multiple loans on them where we've refinanced or topped up over time. What's the best way to go about doing this? Number one, strategically, we need to refinance in order to cash up so we can deploy that capital elsewhere. But what's the best way to start doing that, do you think?
I think the very first thing you need to do is work out what's the purpose. You don't want to be doing it for the sake of doing it. And there's a dollar cost averaging or a value proposition there as well. When I'm talking generally here, in your situation, the very first thing is establishing value, but also making sure that all the paperwork is up to date. Now, as I mentioned earlier on, your sophisticated and complex structure is going to entail that there's a lot more work, I'd say 20-fold more so than potentially another person. Yeah. So it's a time requirement from yourself and the team that is going to be really the challenging part. But if I come back to the purpose, clearly in this case, it is around sharpening the rates, therefore the cash flow position, but also the release of equity so that there's a degree of, or hopefully a big degree of liquidity that might be parked back in the offset to take advantage of other opportunities should and when they present themselves. And when you drill back as to the reason why, other than what I've just mentioned, it's because for me, lending is as good as it gets today. And it's only going to get harder and harder and harder. So if the portfolio has the position where equity can be made liquid, then now is the time to do it. Because once again, it's not going to get any easier. And especially when you have quite a sophisticated and complex structure.
Yeah, you're absolutely right. And if you're going to do the hard work, energy and effort to put together all the information you need for securing finance, you may as well do it all in one.
You may as well do it all at once,
Yeah, because every lender is going to require the same information. And then it gets quite strategic. And I'm working with the team over at Finney Mortgages around, what lenders I go with, how many is a good level of diversity, how many is too many, all of these type of questions. But my sort of sentiments as I go into this process, Steve, is probably to end up at a point where we reprice everything. So we'll probably refinance the whole portfolio. And some of them might just be with the current lender, or it might be with a new lender, resetting a lot of those interest-only periods of 5 years. That will minimize cash flow impacts moving forward. But where there is good equity and where we can leverage that is to refinance a number of these properties as well, so we can cash up, so we can look for those opportunities as and when we're ready to go.
Yeah, and some of it may not be about the releasing of equity, as you point out. It might be a repricing scenario. There are properties within the portfolio that I would like to see repriced, however, the equity not touched, because they're more of a fickle investment and might be tilted towards cash flow to support the bottom line, so to speak. And there are others within the portfolio that were purely capital plays to be able to perpetuate further. But there comes a point in any portfolio where you depending on what the goal is, you need to stop raping and pillaging, so to speak, where you just keep taking and taking and taking and taking. There has to be an end point. Now, whether that's dictated to you by the finance ecosystem or whether it's by choice, because ultimately the goal might be to have zero debt against a portfolio. So clearly there has to be a pay down scenario somewhere, whatever that looks like to you. But I don't think we can also forget that the initial capital that was allocated to create the portfolio has been extracted probably many times over since.
Yeah. So the portfolio owes us nothing. And we've spoken a lot this about in the future where we sort of ponied up the original chunk of change in order to get going with this. And when we refinance, we pull that money out. So essentially you talk about return on capital. Well, it's a million gazillion percent, right?
Exponential.
Because there is no initial capital left in his portfolio. So, on that basis, it's a good portfolio, the good capital growth. And I think it's a really good case study on how you go about doing this. We're comfortable, quasi-comfortable with the cash position, but that's what we're talking about right now. Now, we might only top up 2 or 3 of these loans to extract equity, and the rest of it might simply just be a complete repricing of it and resetting of the interest-only period so we can use this next period of time to minimize cash outlay and maximize additional investments moving forward. Something significant will need to happen in terms of turning this from a negative to a positively geared property, Steve, and I'm thinking that is probably a commercial property to help with that if that's what we choose to do. But we're toying with a whole bunch of other ideas in terms of development inside of this portfolio moving forward, whether or not we can actually develop anything we have right now. And we have an asset down in Port Kembla that we're considering around it, or do we buy fit for purpose properties where we're doing it for the purpose of development. So this is where we're thinking also with this portfolio now that we've got the good base foundational property portfolio sorted out. If anything, we could probably do with less properties in the portfolio at a higher value, and that's probably the way we're going to go.
Yeah, and it once again fit for purpose. The base has done its job. Yeah, it's created the stability in the equity position to now bracket creep, so to speak. Now, just in relation to commercial though, and commercial, while the purpose is cash flow and hopefully growth as well, there is an element of risk with commercial that people need to clearly understand, and it's not all beer and Skittles. And for me, the dollar value you spend on commercial, especially in this portfolio's position, if we're looking to adjust the cash flow situation, then we're going to need to spend a fair bit on commercial so that cash flow needle moves enough to warrant the risk associated with it. But in terms of development, we could also adjust the cash flow position via putting secondary accommodations on probably 3 to 4 properties, which would immediately adjust the cash flow position and give some pretty good benefits on the flip side around deductibility. But also, as you mentioned, there is Port Kembla, which could be potentially a knockdown rebuild for high-end property if we can just get the moons and the council regs to align.
Yeah, and there's a lot there. So this is all the what is with this portfolio, but it still comes back down to capital, the finance side of things and capital. And there's plenty of equity in there, but do we want to sort of unnecessarily pull equity out of it that we don't need to? You mentioned there, and I know a lot of investors are doing this right now. While they're in the motions, they're refinancing. They're topping up to 80% and they're just parking money in offsets. So it's not necessarily costing them any more money to hold their portfolio. However, it is influencing their entire debt position. So even if you've got 100% of a loan offset in the eyes of the bank or other lenders, they're going to be deeming the fact that you have that debt and therefore you're liable for that debt. So it's nice to actually sit there and refinance everything up to 80% and keep stuff in offsets, but that's going to completely change your overall debt position, which may make it more difficult to get other finance into the future. And I think a lot of people sometimes forget about that, Steve. Yeah,
it's a very good point. The debt position clearly is something to think about, even though there is hopefully a great deal of liquidity and you've parked it in your offset or whatever it may be so that it's not costing you anything. That requires a certain amount of discipline though, as well, not to spend it on sort of unproductive or non-productive debt.
Go buy yourself. Well, you can't even buy a brand new Holden Commodore now. They don't make them anymore, do they?
No, you can't get yourself a Land Cruiser either. You've got a 12-month wait. But what the extraction of equity does, and even if you park it back into an offset, it's changing the overall serviceability position on the portfolio. So the debt position is one thing, but more importantly, it's the serviceability scenario. And that's where the good bank or the good broker needs to find that sort of equitable position, that fine line where hopefully you can extract the equity, but also be in a position to borrow further for more asset accumulation, if that be the case.
Yeah, and I always like doing a portfolio update, property update on the Smart Property Investment portfolio because it just makes me reconnect back in with the portfolio. And I don't think about it every day. I know it's there. It's sort of reasonably well managed. It's in pretty good state. Some of the interest rates are a bit high. We spoke about this, but it makes me sort of want to go and just go through all my different banks and make sure my interest rates haven't moved behind the scenes when I haven't been watching. And there was one of them just the other day when one of them come off a fixed rate product to variable, and they racketed it right up on the variable rate. Yeah, which was 1% higher than what I was paying at fixed. It was 5.something%, right? And it was a big loan as well, $800,000 on this thing. And I just went, hang on a second. And I had a big argy-bargy with the bank around it. So, I know I reset it, but I haven't gone back and checked it. So I still don't know whether or not. Yeah. I don't know if I'm still paying that and the bank deliberately forgot to do it. And I've been there and I've fought with banks, hammer and tongs over a period of time with complaints and all this sort of stuff. They took pretty seriously, to be fair. But it's fatiguing work. It's not the most glamorous of work, but you got to get your house in order.
Literally, it's all those little things. And it's like one of the things I suggest for clients is to just make sure they set something as simple as a calendar event for when those loans come off either the fixed or the interest only, so that at least the calendar event's going and subconsciously to be able to pick up the phone and say, I've got to get onto this now, rather than it just happening in the background and potentially around this time of the year, not forgetting it, which probably just comes into my head, Phil. check your insurances, because I just know historically that you've got 4 or 5 that come off around Christmas.
I think we're right across the Steve. Don't worry about that, mate. But what you're talking about, I need to go through and just because I've got it set up in a way in which I can look really quickly. Okay, when is the interest only period coming off? When is the insurance fall due? All that sort of stuff, and it's just admin. It sounds like it's just admin. It's as in it's not that important. It's bloody important. You get your administrator right, but good admin means that it shouldn't be hard to do. It should be easy to do once you get it all set up. But
it's process driven. A lot of investing is process driven.
Yeah, being process driven and knowing what processes to follow, and again keeping it really simple. But I want to be thinking about what we can do moving forward. And in 2022, we do want to start buying again. Let's get into that. Let's get another break. Stay with us. Back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back, everyone. Phil Tarrant from the Smart Property Investment Australia with Steve Waters, Right Property Group, chatting through the Smart Property Investment portfolio and buying property. Now, Steve, as we go down this pathway of potentially developing, to your point, we could probably move the needle a little bit on putting sort of dual incomes on properties, and by that you mean sort of granny flats. I'm not that attracted to it. It just sounds like to me a whole bunch of hard work for a little bit of gain, whereas I'd much rather get bigger bang for our bucks through developing. Now, we're talking about this property we have down in Port Kembla, and this is an area identified by you and presented to us back in 2015, somewhere thereabouts. Somewhere around there. We bought probably one of the worst properties on one of the better streets in Port Kembla, in a place where if we were to develop and go up 2 stories, we'd have nice ocean views. And Port Kembla, by the way, has got one of the most beautiful beaches in New South Wales, wins awards all the time. Once they blew up that smokestack and they're starting to change the demographics of the area, I think Port Kembla and those areas around there will continue to shine. And we've spoken about it. Port Kembla, I would say, falls into this thesis I have now of rural and regional properties within striking distance of your CBDs are the ones that which are going to be attractive moving forward, whether or not we saw that back when we invested in this property. But we bought this thing cheap. It's going up rapidly in value. That's a potential development site that we need to be looking at. But when you look at the portfolio, Steve, is there anywhere else, any other areas that we could develop? We have a property in St. Mary's. You can go and check it out on smartpropertyinvestment.com.au. It's on a corner, ripe for probably, I would say, some sort of duplex. That's probably the smartest and most simplest place to develop when you consider 2-street frontage, absolutely flat block. Similar types of developments have happened or are happening in that particular area. It's within the whole precinct now, which is really sort of accelerating in value around St. Mary's being the hub for transport networks out to the Aerotropolis out at Badgerys Creek. Everyone's talking about it. That would be an obvious place for us to start.
It would be an obvious place, but it would almost be, it's something that I wouldn't be earmarking for right now to knock down a perfectly good property to build, +1, so to speak. Yeah. And that's why that was one of the properties in the back of my mind for that secondary accommodation, should it warrant it. Now, what I mean by that is if the position of the portfolio, the cash position of the portfolio became crucial, where we needed to adjust to create cash flow for survivability, well, that would be an obvious choice with probably 2 or 3 others. And that cash flow position could change quite remarkably, quite quickly. But one of the things around the construction at this point in time, no matter what it is, are those bottleneck supply chain issues, which is forcing the cost of construction up some 30% and potentially more. That will have a direct effect clearly on the cost of construction, but there's going to be a flow on down the line for that, all through to clearly value, but also the return on investment for the investor via their rents. From a a very bigger picture result, if you will, because it's not just on that individual property, it's across the whole of the country. So there's definitely going to be some pivoting over the next year or so and coming all full circle back to the position around finance.
Yeah, you're absolutely right. And a lot of people sort of get swept up in development. And as we sort of we've just gone through this. Now, if you started developing property back in the 19s or 2018, 2019, did all the hard work, broke ground and started completing those properties or selling them off to plan and completing them sort of in 2021, I reckon you've done pretty well in property development. But property development runs in cycles, and even the best property developers find themselves at some point in time in a spot of bother when markets move in a way in which they haven't really accommodated for. Now, we're talking about growth in 2022, albeit at a slower rate than what took place in 2021. Forecasters talking about a slowdown and maybe at least flat or negative growth in 2023. So start thinking about developing property now on the basis that when you hit 2023, when you're selling these properties, it's going to be the sun shining. That might not be the case, compounded by the fact that, number one, good luck trying to find a builder right now. Number two, good luck trying to get materials that are at a price which makes the numbers stack up. And point number three, try and find yourself blokes and girls who can bang a hammer or lay some bricks or put some gyprock up, because they just don't exist in Australia at the moment because we're waiting for skilled workers to come back in. So maybe not the best time to be doing a development. However, probably not a bad time to be thinking about acquiring assets for development into the future, i.e. 2024, 2025.
Yeah, I'd agree with that. And I think controlling the opportunity for the future, that's the name of the game when investing in real estate. It's not the dollar tomorrow, it's the opportunity that will be created over time. The interesting thing for me, though, is just to couple on to the back end of your conversation around trying to find a tradie, try to find materials, et cetera, those that do them and that develop today and pay the premium for the development and pre-sell them may find it challenging in the next, call it 2 to 3 years, for the purchaser to complete based on will it stack up at contract price during the valuation, and that'll be history repeating itself. Which it always does. Yeah,
that's a really important point. What Steve's talking about there is, say you want to do a development, and we're not talking about building, skyscrapers with 200 apartments in it, right? We're talking sort of, 4, 5, 6, 10 townhouses mainly, maybe, or a small apartment block, right? Sort of, it's not mum and dad investing, but it's not like your institutional sort of investing. And there's a lot of people operating in this space now. In order to get the finance, you need to get pre-sales, and I'm sure you can probably sell these things with a nice glossy brochure and promises of price increases by today's price to get the benefits moving forward. You might get those contracts, you might get them signed, and you might get those deposits, and the bank might lend you the money so you can undertake the construction process and everything connected with it. But at the point in time when you're ready to hand over the keys to property purchase A or B, and they go, we contracted it $800,000 for this, but the bank reckons it's only worth $700,000. I can't do it anymore, or you need to sell it to me at $700,000. And this is what happens all the time when it comes to this cyclical nature of development, where you either rip up the contract, you keep the deposit, you got to try and sell it to someone else, or it just sits there stagnant and you're carrying the debt for the property. You haven't been able to offload it. You got to still furnish the debt to the lender. Developers can find themselves in trouble.
Yeah, and that's why developing is a very risky scenario, as long as you can time it perfectly.
Yeah.
And that comes back to my point around controlling the opportunity for the future to build, potentially in a timed process, to hit the ground running on the rise rather than what could potentially be the peak of a market. And as you mentioned, valuation's not stacking up. And what about if the finance ecosystem changes and there's no more 90%, it's 80%, there's no first homeowners grant, et cetera, et cetera, et cetera. Now, that's clearly, I'm being extremely pessimistic here, but developing, I believe, requires that type of filter on it of the what ifs and where can you survive if those what ifs eventuate.
Yeah, and doing your numbers conservatively. Look, there might be upside. Who knows what happens with markets? But most property investors want to sort of make at least 20% on the way through, right? Would be sort of base level stuff for the time and effort.
Yeah, look, I prefer to be cutting 30%, as we call it.
Yeah.
But that's going to become more and more difficult as the supply chain bottlenecks continue to happen. And then you throw in the latest variant of COVID, and that's only going to put more pressure on the supply chain networks throughout the world.
Well, listen, we're waiting for the borders to open up so we can get some Irish builders out here who typically flood our construction sites and get the jobs
I don't know
done.
if they will. I don't know if they will this time around because their market is doing extremely well.
Yeah, there you go. They're not sort of trying to get out of the town to try and find opportunity. And again, this is something that's all environmentally. This is sort of the intersection between macro and microeconomic forces.
Correct.
And how it sort of shapes or impacts the Aussie property investors. So that's one area we're looking at is development. I think we'll pursue that, buy some properties for purpose. Obviously, that will stack up if we didn't develop them, but have those potential. I'm not talking like big stuff. I'm probably talking sort of 3 to 4 townhouses is where we'll aim. But we're also thinking, Steve, around some land banking. So the notion of land banking, 30 years ago, it was buying up heaps of land out Badger's Creek Way on the basis that they might build an airport. Some people have probably done pretty well out of that. But land banking now is probably a little bit different. Land banking can be sort of smaller land banks. Where do you go and buy 20, 30, 40 acres these days on the basis that in time the urban sprawl will hit there and they'll get rezoned, Steve? What's your thoughts on this?
It depends on how long your view is. If you took somewhere like Sydney, well, eventually that sprawl will get there. It's just been creeping and creeping, and you could argue that all areas do that. But over time, depends on how deep the pockets are and how or what ease to sustain the rather large debt when you are land banking and to be able to make the reward. So if you go back to the Badgerys Creek scenario, there was a lot of market gardeners in there, a lot of dairy farmers, and then there clearly was the people that land banked for this, what's happening right now. But yeah, they might have been a syndicate or someone that was just very well versed in terms of their own position to be able to carry it for some time.
Yeah.
And that's the key, is to carry it for some time, because no one is ever going to know when they're going to sign off on that piece of paper to change the zoning of an area. I remember parts of New South Wales or Sydney in and around Box Hill, which was going to happen since the early 2000s, and then it got cancelled probably 3 times. So a lot of people who were land banking lost a lot of money because they couldn't afford to hold it for that long. Had they? Well, today that's a different story. So go into land banking with your eyes wide open and very deep pockets.
Yeah, and look, I think it would our portfolio would benefit from not too much of it, but some land banking. Where, who knows? But land banking can even be sort of buying up 2 to 3 or 4 adjacent properties in a already established area. That can be land banking as well. It doesn't need to be greenfields with cows on it, right?
No, exactly. It could be, I don't know, take Port Kembla, then the block next door as well. And then suddenly we have a 180-degree water view property in an area that's, should I say, gentrifying with lots of knockdown rebuilds, and the dynamics change immediately. That's a land banking scenario.
It's actually a good idea. Maybe we should door knock next door, Steve.
Already done. Already happened.
Because on one side, I think it's been developed. The other side is not. It's a better property than what we have. But and but even if it's behind, right? Because I think the fence alignment is pretty good. That's good land banking. You build.
That's great land banking.
Nice little development there. So that there, I like the idea of that as well. So lots of opportunities, but it still comes down to the great work the team at Finney Mortgages now need to do in sorting out the finance around it, sort of getting good, smart instructions from me about what I want to do. It's not like, hey, can you tell me what I can do? I need to say, here's a portfolio. These are the properties I want to refinance. These are the ones that I want to top up. These are the ones I want to keep the same. These are the ones that I want to fix. These are the ones I need flexibility, so they need to be interest only. And then furnishing them with all the information they're going to need in order to sort that out. No doubt they'll probably start with the lenders it's currently with, who will probably want to keep the business. And I just did some personal stuff recently, and I was able to move stuff because I was increasing my debt with one particular bank, probably shaved about half an interest rate off what I was paying for exactly the same property. So a lot of the lenders will accommodate it if you go through the process around it, because they don't want to lose those loans.
They don't, but there's not a lot of loyalty either. And please, banks, don't come ringing me and crucify me on that comment, but it's a fact. And I think a lot of lenders may rely on the laziness of the consumer not to go through the heartache to change.
Of course.
And every basis point or every blip is dollars in your pocket. But it's a good point that you made around instructing the brokers on what you want. And that's not potentially from a technical point of view. It's from what's the purpose, going back to the beginning of the conversation.
This is the outcome that I want. The reason why you go away and work out how
Shazam it, make it happen. Yeah. But the one thing that was very important in what you said was around the property, not just the overall portfolio's purpose, but the property's purchase. And an example of that might be that you want to extract equity, but you don't want to fix the rate because there's a bigger plan for the property in the short term.
For example, this property we're talking about in Port Campbell or even in St Mary's would be silly to fix those loans.
Correct.
Because to get out of that would be an expensive exercise. So you're better off having the flexibility. Look, you might refinance it, you might top it up, but if you have a interest-only loan on it with an offset and you put all that money back into it, well, you're not really paying anything more and you're probably getting a sharper rate. So, these are all the little bits and bobs. And I'll share that as I work with the guys at Finny Mortgages around it. You go and if you want some more info on them, Finny, just go to finny.com.au and they're happy to have these chats with you as well. I'm sort of picking their brain around it. So go and say g'day to them. Oh, that's good, Steve. Well, it's time for action 2022. Let's get it done. We can now move with we've got everything sorted out. We can now move with a lot of decisiveness. Refinancing 17 properties is going to be good fun.
Yeah, it'll be a hoot. It's who'd want to be a broker?
Who want to be a broker? Who want to be my mortgage broker? Oh God, I apologize in advance. No, we've got a really good. They're really cool. They know what's coming. But and the thing is also, I'm going to talk a lot about this. Going through this journey of refinancing the portfolio. So hopefully everyone can learn from how I go about doing it, so you can avoid some of these pitfalls and complications around it, but also the smart ways to doing it. My point would be: number one, get yourself a good broker. Number two, know what you want and be a good client for them by steering them down the way that you want them, but relying on them to give you the right insights and recommendations. Thanks, Steve. Always good to catch up, mate.
Yeah, pleasure as always.
And I'll see you again soon. We'll bring you back in. We'll do another portfolio update. Steve Waters, Right Property Group. Hope you enjoyed that, everyone. Remember, go and check out smartpropertyinvestment.com.au. Go and check out the portfolio there as well. Favour for me, if you like what we're doing, it's just not myself here chatting. I've got a great team here who make me sound good. The engine behind this podcast, they really get a kick out of reading those reviews wherever you listen to it, most of it on iTunes. If you can leave a quick review, really appreciate it. Thank you very much. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.